I'm joined by the two experts I should say, with very different views. Nomura International's Peter Westaway says they'll start going up at the start of next year. Vicky Redwood from Capital Economics is saying that rates could actually stay frozen until 2014. So, Peter, let me start with you and actually look at the case for raising rates or not. And I'm just wondering if Spencer Dale and Martin Wheel are actually losing ground in the push for higher rates, given the poor economic data we've had recently, poor manufacturing, poor retail sales, and then, of course, a meagre 0.2% growth in the second quarter.
I think if you look at the data outcomes in the UK, the headlines are perhaps a little bit weaker than what the underlying numbers, the underlying situation is really saying. There have been a number of distortions to data to do with bad weather at the beginning of the year. The royal wedding had a big distortion. I mean, one of the things that the ONS told us when that 0.2 growth number came out is that you stripped out those distortions, underlying growth was actually 0.7%, which is actually pretty much consistent with a gradually recovering economy. So I think the underlying picture in the UK isn't quite as bad as all that. I mean, there is a big black cloud hanging over the UK, which is, of course, the sovereign crisis. And I think if that continues to be as fragile as it is, then I think we're in a different situation. But leaving that to one side for now, I think that the underlying situation isn't quite as bad as the figures make out.
And so, Vicky, what is your response to that? Do you think the MPC will give as much weight to the second quarter GDP figure, given the temporary factors that we keep hearing about, the fact that they've pulled down growth, or is there just too much emphasis on these temporary factors?
I think they will be cautious about interpreting those figures, of course. But I think even if the ONS were right that output did grow by more like 0.5, 0.7% in the second quarter, that's still only a 0.7% rise over the last 9 months, and I think that's a pretty dismal performance. And the news we're getting about the start of the third quarter is pretty bad too. The survey's coming off quite quickly. So our view is still that the recovery is fundamentally in trouble, really, and it's not really going to pick up much pace.
Would you be concerned about rates being raised, Peter, in an environment where growth isn't what it should be and actually the global environment is worsening as well?
Yeah, I think I would be concerned. If the global environment really takes a downturn, then I think the MPC will be very hesitant about raising rates, and that's clearly why the MPC have been sitting on their hands for this year. I mean, it was only the beginning of this year that the MPC were pretty clearly signalling that they were ready to start removing accommodation. I mean, the thing that we haven't mentioned yet is the inflation rate in the UK. This is what Spencer and Martin are talking about in terms of wanting to raise rates. We've had an average inflation rate of 3% relative to a target of 2%, and that's been for the last 5 years. This isn't a temporary overshoot, it's very persistent, and so the danger is that things are going to get out of hand.
OK, well then let me pick up on that. Vicky, inflation more than double the government's 2% target. Is that something to be concerned about? Does that boost the argument for raising rates?
Well, obviously the MPC can't be complacent about it, and certainly it's remaining very alert to the risks that inflation will stay high. But I think so far we've seen fairly little evidence that there's these second-round effects on inflation expectations, for example, from the high rates of inflation. And we still agree with the MPC that the factors keeping inflation high are primarily temporary, and that inflation will fall sharply next year. So from our point of view, inflation, of course, we should keep an eye on it, but it's not really the big problem that perhaps those members of the MPC voting for a hike think it is.
Yeah, and actually, Peter, I wanted to ask you about comments from Bank of England policymaker David Miles, actually saying that attempts to slow inflation too quickly could actually create some, what he calls undesirable volatility. Does he have a point?
Yeah, of course. And I mean, I think the inflation rate is going to come down anyway without any increase in interest rates. And, we don't want to be in a situation in a year or two's time where suddenly inflation is undershooting the target. So, I mean, David Miles has got a point. I mean, I think the trouble with these MPC members being characterised as doves and hawks is I think all of them are very aware of the risks on both sides of these arguments.
OK. And Spencer Dale, Martin Wheel, I mean, part of their argument is that weakness in growth actually reflects a reduction in both demand and supply potential, Vicky, meaning that it won't actually affect the inflation outlook. Is that something to be considering here as well?
It is. Again, it's one of the really big uncertainties that it's hardest to pin down, really, how much potential supply in the economy has been affected by the recession and what potential growth is going forward. Those people thinking that rates should rise probably think that quite a lot of the output lost in the recession was lost for good. output is about 10% below where it would have been, productivity is about 10% below where it would have been, and we just find it hard to imagine that much has been lost permanently. And so if there is a bit of spare capacity in the economy, then there's certainly room for the economy to grow quite strongly without generating these inflationary pressures in the medium term.
Yeah, and I guess, Peter, a reflection of the conditions and some of the data that Vicky is touching on there is the fact that we haven't really had any wage growth, which would lessen the likelihood of inflation becoming entrenched in the economy, becoming more of a long-term problem?
No, certainly. I think this issue of how much potential has been lost is absolutely crucial. I mean, I think our view is that rather more has been lost than many commentators are saying. I think if you look at some of the survey-based evidence, firms saying how much spare capacity have you got, they've probably got rather less than a more naive estimate might suggest. But you're right, wages are key, and at the moment, because wages haven't picked up, that's another reason why the balance of the vote on the MPC is still to hold off.
OK, and Vicky, you're saying, just to wrap this little chunk up, you're saying no rate hike at all in the near future, right? So when will they raise rates?
Well, we don't think until 2013, perhaps even 2014, if we're right in expecting the recovery to remain pretty sluggish for the next 1-2 years.
Peter, you're saying early next year?
Yeah, we think the first quarter of 2012.
So, Peter, let's talk about QE2 scenarios, the prospects for more stimulus. And you said in your report one of the important points highlighted by the June MPC minutes was that some members thought that we might need more easing, and that also the fact that they would go as far as making a very specific reference to it.
Yeah, I mean, they said that, and then in the last minutes it was less clear that was where they were going. So I think maybe the MPC were a bit worried how much the market picked up on that reference, and I think they may be a little bit uncomfortable about how far out interest rate increases have been pushed. I mean, very much in line with what Vicky's saying. Hardly any increases next year. Whereas I suspect they're going to be slightly uncomfortable with being on hold for that long. But of course, they're always going to be considering that as part of their arsenal of weapons.
I mean, do you think if they did raise rates sooner rather than later, that would increase the likelihood of there being more stimulus?
No, I mean, I think that would be a policy mistake. If they raise rates and then realise later that they need to go back and do
because
stimulus,
some members of the committee have been saying, they should raise rates, not just because it boosts credibility, but actually gives them more flexibility in terms of policy.
Yeah, but I mean, I think the really important point to remember is even with interest rates where they are at the moment, there's an enormous amount of monetary stimulus being put into the economy. I mean, the way Mervyn King referred to it when he was at the Select Committee last year is saying, if we raise rates, we're not putting our foot on the brake, we're taking our foot off the accelerator. So at the moment, they've got their foot flat on the floor, and all we're really talking about is easing off. Interest rates, even over 1.5–2%, is still incredibly stimulative for the economy.
Okay,
I think one thing to remember, though, is that banks' lending spreads, of course, widened quite a lot since the recession. So I think, as Mervyn King himself has pointed out, you've got base rates at 0.5%, extremely low, but actually lending rates are a fair bit higher than that, and that the wedge between base rate and lending rates is much wider than in the past. So I think just looking at official interest rates on their own doesn't really give an indication of really how that monetary policy is impacting on the economy.
No, and I think that's an important point. But I mean, that cuts both ways, because when interest rates do start to go up, what we might see is that the spreads on mortgage rates start to come down. So we may not see a one-for-one pass-through from higher policy rates into higher mortgage rates, which means the amount of tightening that the Bank of England are imparting to the economy is rather less than they intend. So it's a very uncertain time for them at the moment.
Yeah. And when will things become a little more certain, Vicky? I mean, is there enough? I know, because the data has been so poor recently, and everyone you speak to, every economist, there's too much uncertainty. I mean, is there even enough evidence at this point to justify any changes to monetary fiscal policy, whether you're talking about raising rates or boosting stimulus?
I think for now, the uncertainty is probably going to keep both the government sticking to its Plan A and the Monetary Policy Committee just sticking to no change in their policy. I think that uncertainty is going to take a few months to clear up. Even once we get the estimate of growth in the third quarter, we don't know how much that will be due to the unwinding of the temporary factors in the second quarter. And we're going to have to wait until inflation gets towards its peak, which won't be until later this year, before we then find out whether it is actually going to come back down or not. So I think certainly for the rest of this year, most policymakers will just stay on hold.
But Peter, you've said, 10% probability of more QE next year, right?
Yeah, and I mean, that's very much wrapped up with the situation in Europe around the sovereign debt crisis. I mean, in a way, I don't think the UK policymakers are entirely in control of their own destiny at the moment. I mean, our biggest trading partner, the euro area, is undergoing this sort of existential crisis. And if things really did get worse, I mean, that's not our main case either, but if they were to get worse, that's definitely going to have an impact on the UK. So while that's still a possibility, that's why they're holding off
It's
for now.
not your main case, but I know, Vicky, you think the probability is much higher than that. And I just want to put this to you, because some economists, including Danny Gabay at Fathom Consulting, say central banks' bond buying programme failed to feed through to the real economy and has instead been used by banks to strengthen their financial positions. Do they need to explore other types of stimulus?
I think it's certainly fair to say that the first round of QE had a fairly mixed effect. It certainly wasn't the magic bullet for the economy, but I think it's worth progressing with a QE2 because really that's all the MPC's got, but perhaps thinking a bit more imaginatively and maybe buying a wider range of assets rather than focusing solely on gilts as they did in the first round.
Excellent. Thank you very much, Vicky Redwood of Capital Economics, Peter Westaway of Nomura International. Great to talk to you guys. Thanks so much for coming and sharing your views. Good